The COVID-19 pandemic was one of the most profound shocks to the global economy in modern history. From early 2020, governments worldwide faced an unprecedented challenge: how to protect public health while minimizing economic devastation. Lockdowns, travel restrictions, business closures, and social distancing dramatically curtailed economic activity, throwing many industries into crisis and pushing millions into unemployment or financial hardship. As the initial waves of the pandemic receded and vaccines became available, economies began their paths toward recovery. However, it quickly became apparent that not all recoveries were equal. The United States and the European Union, two of the largest economic blocs in the world, exhibited markedly different patterns of growth following the pandemic's acute phase. The reasons behind this divergence are rooted in the complex interplay of policy responses, like economic structures, social factors, and political dynamics. To understand what caused the USA's economic growth and the EU's economic growth to differ after the pandemic, we need to examine these factors closely, step by step. When the coronavirus outbreak forced governments to impose lockdowns in early 2020, economic activity slowed to a near halt. Both the United States and the European Union saw historic declines in GDP and sharp rises in unemployment. Yet, the speed and magnitude of their policy responses varied considerably. The United States, under the Trump administration initially and later the Biden administration, adopted a bold and aggressive fiscal policy response. Congress passed multiple stimulus packages amounting to trillions of dollars within the first year of the pandemic. These packages included direct cash payments to households, expanded unemployment insurance, support for small businesses through programs like the Paycheck Protection Program, and aid to industries heavily impacted by the pandemic, such as airlines and hospitality. This massive fiscal injection was unprecedented in scale and speed, reflecting the belief that rapid and direct support to consumers and businesses was essential to prevent a long-lasting economic collapse. The Federal Reserve complemented fiscal policy with equally aggressive monetary policy measures, cutting interest rates to near zero, buying government bonds, and injecting liquidity into financial markets to maintain stability. The European Union, by contrast, faced a more complicated landscape. As a supranational entity with 27 member states, the EU had to balance the interests and fiscal conditions of very diverse economies. Many EU countries entered the pandemic with higher public debt levels than the US, and the EU's fiscal rules, including the Stability and Growth Pact, had historically limited the ability of countries to run large deficits. Early in the crisis, fiscal responses were largely left to individual member states, leading to uneven support levels. Countries like Germany and France rolled out substantial aid programs, while others with more limited fiscal space struggled to provide comparable support. A turning point for the EU came with the agreement in mid-2020 on the Next Generation EU NGEU Recovery Fund, a $750 billion initiative aimed at fostering economic recovery through grants and loans targeted at investment and reforms. This marked a historic step toward fiscal solidarity in the EU, with the European Commission borrowing collectively on behalf of member states. However, the complexities of approving national recovery and resilience plans, dispersing funds, and ensuring compliance meant that much of this stimulus only materialized gradually from late 2021 onward. This lag contrasted with the near-immediate fiscal injections in the US, contributing to a slower initial rebound in the EU. Beyond fiscal policy, differences in economic structure played a significant role in the divergent recovery paths. The US economy is heavily driven by consumer spending, which accounts for roughly 2/3 of GDP. The direct cash payments to Americans, combined with enhanced unemployment benefits and relatively easy credit conditions, supported consumer demand once restrictions eased. This led to a surge in spending on durable goods, services, and experiences, fueling rapid growth in retail, hospitality, and travel sectors. Additionally, the U.S. has a large and innovative technology sector that benefited from increased digital adoption during the pandemic, further supporting economic momentum. The European economy is more industrial and export-oriented, with a substantial manufacturing base spread across Germany, Italy, France, and other countries. While this diversified industrial base provides resilience, it also exposed the EU to supply chain disruptions and slower global trade recovery. The pandemic interrupted global logistics, causing shortages of raw materials, semiconductors, and intermediate goods critical to European manufacturing. The EU's service sectors, particularly tourism and hospitality, were also hit hard, and recovery was constrained by stricter or longer-lasting lockdown measures in many member states. Consumer behavior differences also mattered. Europeans tend to have higher savings rates and a more cautious approach to spending, especially after economic shocks. Combined with more stringent public health measures persisting longer, this dampened the immediate rebound in consumption. Furthermore, variations in social safety nets and labor market institutions affected how income support translated into spending power. While the US fiscal packages put cash directly into consumers' hands quickly, the EU's more decentralized and delayed fiscal mechanisms meant that stimulus effects were slower to flow through. Labor market policies further contributed to the differing growth trajectories. The United States relies primarily on unemployment insurance and relatively flexible labor markets. The stimulus payments and expanded unemployment benefits helped many displaced workers maintain purchasing power, but the reopening of the economy revealed labor shortages in key sectors. Many workers reassessed their job choices, contributing to the Great Resignation phenomenon, where millions voluntarily left or changed jobs, pushing wages higher in certain industries. This dynamic contributed both to robust wage growth and upward inflation pressures. In the European Union, labor markets are generally more regulated with stronger protections for workers, including widespread use of short-time work schemes or furlough programs. These programs aimed to preserve jobs by subsidizing reduced work hours rather than allowing mass layoffs. While effective in maintaining employment relationships, they also slowed labor market adjustments and reallocation of workers to sectors with growing demand. This approach helped contain unemployment spikes, but also contributed to a more measured pace of economic recovery. Wage growth in many EU countries remained subdued, reflecting weaker labor market tightness. Another crucial factor influencing economic recovery was the pace and efficiency of vaccine rollouts. The United States launched a rapid vaccination campaign starting in December 2020, achieving widespread coverage by mid-2021. This success allowed states to lift restrictions faster, restore consumer confidence, and accelerate reopening. The strong vaccination uptake also reduced severe illness and hospitalizations, minimizing disruptions to the workforce and production. The EU faced a slower and more uneven vaccine rollout initially, hampered by procurement delays, regulatory hurdles, and distribution challenges across member states. Although vaccine coverage improved significantly by late 2021, these early setbacks prolonged uncertainty and delayed the normalization of economic activity. Public hesitancy toward vaccines also varied across countries, influencing reopening timelines and consumer behavior. The delayed and fragmented vaccination process contributed to a more cautious recovery path in the EU compared to the US. Political cohesion and governance structures further explain differences in post-pandemic economic growth. The US federal system allows the central government to implement large-scale fiscal programs rapidly, though political polarization complicated some aspects of policymaking. Congress passed multiple relief bills with broad bipartisan support early in the pandemic, reflecting the urgent need for action. However, political divisions later slowed additional support efforts and complicated public messaging. The European Union's multi-layered governance requires consensus among member states, with widely differing political priorities, economic conditions, and social models. The negotiation of collective recovery funds and approval of national plans demanded significant diplomacy and compromise. While this process ensured broad participation and alignment with EU policy goals, it also introduced delays and uncertainties that slowed stimulus implementation. The EU's emphasis on fiscal discipline and adherence to rules such as the Stability and Growth Pact constrained rapid and large-scale deficit spending in many countries. Monetary policy also played a role. The Federal Reserve aggressively cut interest rates, maintained asset purchase programs, and provided liquidity to markets. signaling a strong commitment to supporting growth. The Fed's forward guidance and readiness to taper easing as growth accelerated reflected confidence in the recovery. The European Central Bank also cut rates and expanded asset purchases, but its cautious approach reflected concerns about uneven growth, lower inflation, and diverse national economic conditions. The ECB maintained ultra-accommodative policies longer, supporting weaker demand but limiting inflationary pressures. Inflation dynamics diverged markedly between the two regions. The United States experienced a rapid surge in inflation starting in mid-2021, driven by robust consumer demand, labor shortages, supply chain bottlenecks, and rising commodity prices. Inflation reached levels not seen in decades, sparking intense debate about whether these price pressures were transitory or more persistent. The Federal Reserve responded by signaling earlier interest rate hikes and tapering asset purchases to rein in inflation risks. In the European Union, inflation also rose but at a slower pace and lower peak. The EU's slower demand recovery, more subdued wage growth, and continued fiscal caution helped temper inflationary pressures. However, rising energy prices and supply constraints still pose challenges, and inflation rates in late 2021 and 2022 began converging toward those seen in the U.S. The ECB faced the difficult task of balancing support for fragile growth with concerns about emerging inflation. Demographics and social factors also influence the pace of recovery. The United States benefits from a relatively younger population and higher immigration rates, which support labor force growth and consumption. The EU faces aging populations and lower immigration inflows in many countries, which constrain potential growth and increase social welfare burdens. These demographic trends shape long-term economic resilience and the ability to recover from shocks. Finally, structural economic reforms and investment patterns matter. The EU's Next Generation Fund explicitly focuses on green transition, digitalization, and resilience, aiming to modernize economies and boost productivity over the medium term. This emphasis on strategic investments will influence growth trajectories beyond the immediate recovery phase. The United States also prioritizes infrastructure and technology investment under recent legislation, but with a different scope and approach. In conclusion, the differing economic growth paths of the United States and the European Union after the COVID-19 pandemic stem from a complex mix of policy responses, economic structures, labor markets, vaccination efforts, political governance, monetary policy, inflation dynamics, demographics, and long-term investment strategies. The U.S. recovery was faster and stronger initially, propelled by large and timely fiscal stimulus, flexible markets, rapid vaccination, and strong consumer demand. The EU's recovery was slower and more gradual, shaped by delayed stimulus, complex governance, structural constraints, and a cautious approach to reopening and labor market adjustments. Understanding these differences provides valuable lessons for policymakers as they navigate ongoing challenges such as inflation, supply chain resilience, climate change, and social inequality. It highlights the importance of timely and coordinated fiscal support, adaptable labor markets, efficient public health responses, and long-term investments in innovation and sustainability. While both the US and the EU have made significant strides in overcoming the pandemic's economic fallout, their divergent paths remind us that recovery is not just about weathering the storm, but building systems capable of withstanding future shocks and fostering inclusive, sustainable growth.